morning, everyone, and thank you for joining me today. I'm very excited to talk to you about our global range of UCITS funds. The range is currently available on the Old Mutual International platform and forms part of its core offering. We recently received Section 65 approval for our global range, and we wanted to take advantage of the fund's one-year track record to share more details on this offering, and more importantly, why a multi-manager strategy should be the product of choice for investors. The range is managed by the Old Mutual Multi-Managers investment team, using the same investment philosophy and process that underpin our successful local strategies. The range offers 3 different risk-return profiles that aim to deliver real returns to investors over time. Now, starting on the left-hand side of the graph, we have Global Moderate, a typical balanced type portfolio, aiming to deliver a real return of 3%. In the middle, we have Global Growth, a more aggressive version with a 4% real return objective. And on the far right, we have our pure global equity offering that aims to deliver a 5% real return over the longer term after accounting for all investment-related fees and charges. As multi-managers, the success of our process relies on different layers of diversification. Firstly, we ensure adequate diversification amongst different global asset classes. Our starting point in the process is to establish the most optimal combination of different asset classes that offers the best chance of achieving the real return objectives for our clients. And this graph showcases such combination of asset classes for each of the global funds. As expected, Global Moderate on the far left needs a balanced exposure to growth assets, such as global equity and property, with the remainder invested in fixed income and cash. Global Growth in the middle requires a much higher exposure to growth assets in order to achieve its higher real return target, while Global Equity on the far right is self-explanatory. We also aim to diversify at asset manager level, and I will touch on this in greater detail in a few moments. This table outlines the current selection of asset managers for each of our asset class building blocks. For those of you who are familiar with our local strategies, you'll probably note that our selection of global equity and global property managers is identical to what we have in our local strategies. There are certainly a number of names you might be quite familiar with, such as, for instance, Orbis, 91, Coronation, amongst others. However, you'll also note that we have invested in a number of names which you may be less familiar with, such as Federated Hermes as well as Harris Associates. Another point I would like to make is that our exposure to global fixed income is quite different to the norm. Given the current low yielding environment and the increased duration risk of the broader global fixed income benchmarks, we opted to invest in mandates of a more flexible nature. These mandates allow the asset managers to seek total returns by exploiting all areas of the global fixed income universe, while also aiming to control risk on an absolute basis. We will hear a little bit more about these interesting mandates in our upcoming conversation with the portfolio manager from Neuberger Berman. If we look at the global funds one-year track record, it is really pleasing to know that all 3 funds are well ahead of their respective benchmarks to the end of February, despite the COVID-related challenges experienced globally throughout the course of last year. The one-year returns did benefit marginally from a slightly higher allocation to cash during the first week of March last year, as we deployed that capital to the underlying funds. However, by far, the largest driver of outperformance was Manager Alpha, particularly within the global fixed income space. Here, managers held onto to their credit and high yielding positions, which benefited considerably given the compression in credit spreads we've seen since March last year. In the global equity space, the building block benefited from an overweight position in emerging markets. It also gained from an allocation to a growth-oriented manager on the back of its extensive exposure to digitally enabled businesses as well as tech platforms, which we all know performed very well throughout the course of last year. Next, I would like to spend some time highlighting the unique benefits of a multi-manager approach to investing in the global space. First and foremost, it offers a rigorous and exhaustive manager research process. We all know that research is vital. Currently, there are over 500 Section 65 approved global funds that retail investors are able to choose from. This is certainly an overwhelming level of choice, even for the most knowledgeable of investors. However, the potential universe of skilled global asset managers expands far beyond this number, and in many cases out of reach from retail investors. In the global equity space, for instance, our starting universe of potential mandates is close to 2,000. One would certainly need adequate resources and the right expertise to access this universe and sift through the long list of funds available. And our role as multi-managers aims to achieve exactly that by applying a consistent and pragmatic approach to filtering the universe down to a more manageable number of funds. Furthermore, we use a combination of quantitative and qualitative analysis to assist us in identifying truly talented stock pickers in their respective specialist areas. At the same time, ongoing analysis and monitoring ensures that managers we have selected adhere to their process and philosophy over time, while also allowing us to identify additional interesting opportunities within these universes. Secondly, we recognize that a manager's excess returns are likely to be cyclical in nature, particularly over the shorter time horizons. And this is because no individual manager can be best in all market conditions. In this graph, we plotted 12-month rolling returns in excess of the broader benchmark for two different global equity managers. What is very clear is that certain market conditions favor one manager's approach when compared to the other. Now, without the right insight into why the individual managers performed the way they did, it is very easy to make mistakes such as selling manager one after a period of sharp underperformance, or even buying into manager two at the peak of their performance cycle. But as we know, short-term performance is certainly not a reliable predictor of how these managers perform over subsequent periods. And using it to make manager changes can be disastrous for clients. So our job as multi-managers is to identify and assess the drivers of manager performance over time and use this knowledge to make more informed choices, even if that means holding on to managers during periods of underperformance, which we certainly have done in the past. Just as important, however, is to recognize that managers' relative performance can be influenced by the investment style that underpins their approach, such as, for instance, value or growth investing. This graph plots the relative performance of the two broad investment styles, value and growth, against the broader MSCI All Country World Index over time. And what is very clear to note is that there have been cycles over time when either value or growth performed better than the broader market. For instance, managers who favor value investing would have done quite well post the tech bubble in late 1990s, supported by cyclicals and commodity cycle. The last 10 years, on the other hand, would have seen growth investing as the winner on the back of momentum in tech innovation. But ultimately, manager diversification aims to offer a balanced exposure to those different investment styles, which provides a more consistent return experience for clients throughout a full market cycle. So by blending complementary investment styles and approaches, we aim to deliver very similar returns at a reduced level of risk when compared to other single asset managers, as indicated by the green dot on this chart. So although the global range was only launched a year ago, we have a long-term track record and expertise in managing global funds. We've been managing the CIS Global Inflation Plus range for the last 15 years, employing the same investment philosophy and process. As a matter of fact, the Old Mutual Multi-Managers Global Range, launched a year ago, overlaps very closely with the CIS Global Funds from a real return objective point of view, as indicated on this graph. The CIS Global Funds have a solid long-term track record of beating the respective real return targets. The more moderate fund, which is the CIS Global Inflation Plus 1, 2, 3, has managed to beat its real return target over all time periods. You'll also note that the strength in global equity markets propping up returns over the 1 and 3 year time periods. The message is very much the same for the CIS Global Inflation Plus 3 to 5, which is a more aggressive version compared to the previous one. And this one also managed to outperform its real return targets over the different time horizons. The CIS Global Inflation Plus 5 to 7, which is the pure global equity version, also managed to deliver returns ahead of its real return target over medium to longer term. So why partner with Old Mutual Multi-Managers to manage your clients' offshore investments? Well, firstly, your clients will benefit from our extensive expertise in global manager research as well as managing global strategies. Furthermore, the funds are managed by an experienced team, and this is underpinned by a successful track record of delivering on fund objectives, both in the local and global space. Now, I think you will find the next sessions very interesting. We have invited a number of portfolio managers to talk to us in greater detail about the asset classes that they specialize in and what are some of the things that they consider when managing funds in that space. First up, we have Craig Woodfield, who works alongside me in Global Equity Manager Research, chatting to Kunjal Gala from Federated Hermes about global emerging markets. Thereafter, we'll have Monine Watson, our Chief Investment Officer, who will speak with Jos Janssen from Neuberger Berman about global fixed income mandates. And lastly, I will speak with James Wilkinson from BlackRock about global property. Although none of these underlying funds are Section 65 approved, the purpose of our conversation with the portfolio managers is not to market the funds themselves, but rather to showcase why we selected these managers in particular and how they fit within our broader portfolios. I hope you enjoy it.
Right, good afternoon and welcome to the Q&A for Global Emerging Markets. We are honored today to have Kunjal Gala from Federated Hermes. Kunjal has been with this firm since 2012. Prior to that, he's had a very successful career, including Her Majesty's Government, Morgan Stanley, Thomas Cook and PwC. Kunjal is currently the lead portfolio manager for Federated Hermes Emerging Markets portfolios. And by virtue of his track record, he's one of the most prominent investors in the global equity space. Kunjal, first of all, welcome. It's an absolute pleasure to have you here with us today.
Yeah, thank you very much for having us on the call. Thank you.
Kunjal, just to dive straight in, so emerging markets, of course, are very exciting parts of global equities. I think we've all witnessed the rise of Asia. We know that over 85% of the global population come from emerging markets, more than 55% of global GDP, and yet emerging markets are still only 12% of the global equity market cap. So my first question to you this afternoon is, how has the EM universe changed over time? And what are the opportunities that you see today versus 10 years ago?
Yeah, no, that's a very interesting question and an interesting way to begin the conversation. Um, Over the last several years, three or four things have happened in emerging markets that have changed the landscape. The first and I think the most important change that has happened is the emergence and the dominance of Asia within an EM context. Um, and that is, I would say, perhaps the most important change. Why? Because, prior to say 2008 or even before that, emerging markets were largely dominated by resource intensive economies, like say Russia or Brazil, South Africa, etc. But last many years, we've seen the emergence of China. China's weight in the benchmark is now close to 40%. And also from a sector perspective, technology has become one of the largest components of our investable universe. So these changes, have happened on the ground because of a number of drivers that have also emerged at the same time: the rising middle class in EM, the digitization of several EM economies, the focus that has been put in place by a number of governments on infrastructure, both physical as well as digital. So all of these factors has led to these fundamental shifts and changes. Also, there has been a increasing awareness about climate change and global warming, and over the recent few years, and that is also shifting the investment landscape. So I would say, yeah, it's a pretty exciting time to be looking at emerging markets, and I'm sure over the next 10 years there will be a lot of shifts that will happen to the landscape.
Many investors get some emerging market exposure from a broader global equity fund, but your main emerging market funds specialize purely in emerging markets. So, from an investor's point of view, what expertise do you believe a specialist emerging market manager offers when compared to a broader global equity fund?
Yeah, it's a very good question, because EM, emerging market economies, are very different from the developed world, not just because they have lower per capita incomes, but uh, emerging markets, unlike the developed world, need a secret sauce, to emerge. And that secret sauce is reform, structural reform. And hence, a specialist EM manager who has their eyes and ears to the ground would know what each economy in the emerging world is doing. I mean, that is perhaps difficult for a global manager because the United States is such a huge part of their universe. A lot of their focus is probably going to be on fewer large global markets or developed markets. Whereas in EM, there are 24 countries currently under the EM benchmarks, and each country has its own unique trajectory, its own unique competitiveness, and a set of challenges and vulnerabilities. So each market in EM is very different from another market, and hence a specialist EM manager, we like to think of it as ourselves who have the experience and a process that is very important. A process which includes top down, combining with bottom up, is very important to evaluate the entire landscape, see what is interesting out there, look at the direction of travel for a variety of countries and economies, and then construct a portfolio which comprises of quality companies that benefit from structural drivers, and most importantly, they are operating in an environment or a country that is creating conditions that are conducive of growth. So I think for that, a role of a specialist EM manager is very important because they bring that local perspective. Then that is pretty important here.
Kajol, Federated Hermes are renowned for having a very strong focus on responsible investing. In many respects, Federated Hermes are at the forefront of active ESG investing. So my first question is, what is the value out of this approach to investors? How important is responsible investing, particularly in the context of emerging markets?
Why are they so important? They are important not just from an EM perspective, but from a global perspective. They're going to impact even the developed world, United States in particular, and equally some of the poorer parts of the world, in Asia or Africa or Latam. So it's a global issue. And hence incorporating understanding of these issues, sustainability issues, is very important to, most importantly, future proof the portfolios. We are going to see a lot of destruction, unfortunately, because of businesses to realize and understand their role in mitigating these harmful effects or adapting to those impacts. In many cases, mitigation might or might not be possible, but adaptation is certainly very possible. So that is why responsible investing or sustainability or ESG integration is very important, to make sure that the companies that we invest in the portfolio are themselves responsible, and they consider the greater good. They consider science-based targets for reducing emissions. They don't waste resources and recycle as much as possible. Because we are living in a world with finite resource, and the quality of environment is deteriorating. So that's why businesses have that moral responsibility to adjust. If they don't do it, the regulators will do it for them, and there will be a cost associated with that. So it's better, for us as portfolio managers to think longer term about these sustainability issues and make sure that we avoid unsustainable businesses, and we engage with our company so that it becomes better for all stakeholders, and that is how we can deliver a holistic return to our investors. So I think that's why responsible investing and sustainability is become so important.
Kajol, many investors think that ESG simply means removing companies with a low ESG score. Of course, Federated Hermes, your approach is much more comprehensive than that. How do you balance your focus on responsible investing while still maintaining a broad enough opportunity set to choose from?
Yeah, so scores, that has always been a source of debate, of what sort of value scores really add. So at Federated Hermes, our approach has been that while we do look at scores, we don't consider the scores as the final word on ESG. Not because that we don't believe in scores, etc., but sometimes data can be quite patchy in emerging markets, and lack of availability of data could possibly impact the scoring, and hence you don't want to miss out on something just because the researcher didn't find the data, and or sometimes didn't care to find the data, and hence gave a lower score. So what we like to do is go beyond the scores, look at the qualitative aspects of ESG, and most important for us is the direction in which the company is traveling. Uh, and I think that is something which a score might or might not be able to capture perfectly. So we balance the quantitative with the qualitative, and that is how we make sure that we are not excluding companies just based on a low score, but also incorporating opportunities where companies are conscious and are moving in a positive direction, and hopefully in couple of years time the scores would reflect that. So I think it's a little bit of that we focus on.
Excellent, thank you, Kunjal. Finally, just to touch on the topic, I think on all of our minds, it's been a particularly challenging period to invest. So we've had, in the space of 12 months, a global market crash and subsequently a very strong market recovery. Of course, the future is still very much uncertain. In that context, how has this last year changed your view of your portfolio? And finally, where do you see opportunity ahead specifically for the companies that you invest in?
Yeah, so last year was a very challenging year, not just for the volatile trading environment, but because the last year resulted in a number of fundamental shifts. Let me just talk you through some of those shifts and how we responded to that. So one of the biggest fundamental shift that happened last year was the healthcare systems globally got a shock, right? A shock that they were not prepared for. And I think that is likely to result in a lot of change in the way healthcare is delivered across the world. Emerging markets were found to be deficient in hospital bed capacity. Some countries in the developed world were found to be not having enough manufacturing for, say, vaccines or protective equipment, etc., and they were left to be dependent on other countries. So in times of pandemic, this creates some security of supply issues, because countries are prioritizing their own population rather than thinking about others. So, and crucially, R&D. Not many countries in the world have research and development capability to innovate on the medicine front and create vaccines. So I think over the next several years, we'll see a number of countries push ahead on healthcare infrastructure and healthcare capabilities. And I think that could result in some interesting opportunities from an investment perspective. The second area where we see a much larger structural shift is the enterprises. And when you divide the enterprise into two, one is traditional enterprises, the brick and mortar companies, and the new economy enterprises, the Amazons of the world or Tencents and Alibabas of the world. The traditional enterprises also got a very big shock last year. They saw that their online counterparts were able to operate business seamlessly with very minimal disruption. They were able to adjust very quickly because they were very agile, and they didn't have any problems communicating with their customers because of digital technologies that they adopt. So traditional enterprises got a very big shock and said, look, somehow this year we've survived, but the next pandemic or the next major disruption, we might not be able to survive. And hence there is a realization that we need to operate like an Amazon operates, agile, digital, focus on new age technologies, focus on innovative ways of communicating with customers, making sure that e-commerce as a channel receives the importance that it has not received in the past. So traditional enterprises are now looking for ways to save money and save costs so that they can redeploy that savings and digitize themselves end to end, so as to make sure that they remain resilient and relevant going forward. From an EM perspective, what is also important is the importance of insurance has suddenly come up. In emerging world, insurance was never really considered as an essential product, both health as well as life. And the pandemic last year opened this avenue up, and we are seeing a lot of interest in a number of emerging markets where we already have investments in insurance companies, and they are telling us that they're seeing a lot of inquiries for protection products. So I think that again is a very strong kind of driver going forward. And finally, I would say the role of technology in all of that has become even more important. So technology, which used to be a support activity, has now become the center of all businesses or business activities, and businesses are technology businesses nowadays. So if you talk about a bank is what? Borrowing money and lending money. Yes, that is. But banks are also now becoming fintech organizations. Similarly, a retailer is becoming an online delivery expert. So businesses are becoming technology businesses, and that itself has a lot of interesting implications, because the backbone of all technology is hardware, software, and semiconductors. So these three areas will remain in demand, for the foreseeable future. We are seeing very strong double-digit growth estimates for companies exposed to these areas. So the role of technology is only going to get important going forward, and I think there is a lot of opportunity there. So I would say these are the kind of fundamental shifts or changes that we've seen because of the pandemic last year, and all these changes are ongoing. And the way we have adjusted our portfolios is as follows. One is we have looked very hard look at our portfolio and make sure that we don't have any vulnerable companies or companies that can get further disrupted. So we got out of a few names that we thought were vulnerable from a longer term perspective. The second is we placed importance to healthcare in the portfolio. We invested in a clinical research company in China. We also invested in an online health delivery platform in China. So we made sure that we have adequate exposure to these new emerging healthcare oriented themes. In enterprises, we have done a lot of work and made sure that companies that we invest in, especially traditional enterprises, a bank or a retailer, understands the importance of digital and has the necessary skill set and talent to make sure that they don't fall back on that journey. Similarly, insurance, I already spoke about. We have that exposure already in the portfolio, and technology is another area where we are already overweight, significantly overweight. So we're benefiting from some of those structural changes that are happening.
Brilliant, Kunjal. I think that's an absolutely excellent summary. I think that brings us to a close for this afternoon. Kunjal, as always, it's been an absolute pleasure to hear your thoughts. So thank you very much for joining us this afternoon. Really appreciate it.
Thank you very much. Thank you.
All the best. Thanks.
Good day to everybody that's on the call today. I have Jan Janssen with me from Neuberger Berman. He joined Neuberger Berman in 2013 from JP Morgan, where he'd spent 15 years, the last as the head of their global aggregate team. At Neuberger Berman, he's a senior portfolio manager for global investment grade and multi-sector fixed income strategies. Now, that's quite a mouthful, and I'm hoping that in our conversation today, we can provide greater insight into global fixed income, and particularly the kind of mandates that we've included in our global strategies. So welcome, Jan. We appreciate your time, and thank you for being with us today.
Yeah, great to be here. Thanks for inviting me. It's great to see you again.
Super. So Jan, we've spoken a lot about fixed income over the last few years, but if I look at it from a South African investor's perspective, South African, bonds offer very high yields. When you look offshore, yields are very low. They have been low since the financial crisis, and COVID has pushed them even lower. So what is the role of global fixed income in a global balanced portfolio when yields are so expensive at the moment?
Yeah, no, traditionally fixed income, the role of fixed income has been to provide stable return, liquidity, and diversification. I believe we can still meet all of the objectives, of that stable return, liquidity, and diversification in flexible mandates. As an example, in our more flexible global opportunistic strategies, we have consistently generated over 5% return. So I think it's not, only to focus on the yield. There are always opportunities within fixed income to generate returns that is more important to the investor rather than the headline yield. And while yields have been compressed since the GFC, our returns have not been hampered by that. And as I said, for the last 8 years, we've generated over 5% annual returns in a low yield market. Fixed income markets are inefficient in their pricing, and we believe it's possible to extract that relative value from fixed income markets throughout market cycles to achieve this. We use a sensible, repeatable relative value framework that enables us to meet and exceed those objectives that we set forth in our fixed income portfolios.
Thank you, Jan. Maybe to provide some context for the people on the call today, if you look at the fixed income market prior to the GFC, I mean, yields were higher, and I mean, people maybe invested purely in sovereign kind of debt. But as yields moved lower, there's been a need for a more flexible approach, which is what you've spoken about. Another way to look at fixed income, beyond just a benchmark cognizant approach. So if you can give our viewers today some kind of insight, in what you've been speaking about in terms of all the tools you can use to provide, to build this kind of flexible mandate where you can generate an absolute return, despite the fact that sovereign bond yields today are very low.
Yeah, it's when investing in fixed income, it's very important to look at the balance of risk between duration and credit risk. They typically are the two biggest risks that you face, and depending on the mandate, in some cases, currency risk, depending on the strategy. So having that flexibility to shift duration and credit risk is absolutely critical to generate that stable return and to protect capital. For example, now, we're in an early stage of the credit cycle where credit fundamentals are improving, as is growth, and we think credit is the sweet spot. And duration is what you need to want to control for, and be careful where you take your duration positions. So currently we're focusing on and emphasizing yield with minimal duration risk, and so in our flexible strategies we've reduced duration and government bond allocation to protect capital. So that's important, as government bonds can be good to protect capital in a risk-off environment. In today's market, you need to avoid government bonds and be careful. So as an example, we're here in beginning of March to 21. Most traditional fixed income benchmark have posted negative returns, and you take, for example, Global Ag, that is down over 2% year to date. While with our flexible strategies, we have been able to generate positive return. And this is all about shifting that balance between duration and credit. And that's absolutely critical to protect capital and to generate that return. And that was a very different position from last year when you wanted to own duration, and later in the year you wanted to own credit. So we were able to generate very positive return last year on given the volatility. But now, as we start, reflate the economy in this early stage, credit is the sweet spot, duration is what you need to control for, and be careful of where you take that.
Yeah, I suppose on the other side, when you look from a South African environment, then credit just sounds risky in many ways. Are these portfolios risky? I mean, one big part of your process is about managing the downside and generating that absolute return without the downside risks, and yet you speak a lot about using credit. So how do you balance what people perceive as risky in terms of credit with this absolute kind of mindset that you have in managing the strategy?
Yeah, so there are obviously our process is very critical. We use a relative value approach where we assess all the different sectors available in fixed income. And looking at the tail risk is very important to our process, where we look at what are the possible outcomes over the next 12 months for the different sectors, assess that return relative to that downside, and make our allocation decisions that way. Obviously, maintaining high level of diversification is also very critical. As we found out last year, things can change quite quickly. So diversification is very critical. And then, we maintain, despite having ability to allocate to credit, we always maintain an average investment grade credit rating in the fund. And if you look at our volatility of the fund is in line with what you would consider investment grade like benchmarks. But we can achieve that, with investment grade like or investment grade rating or better, investment grade like volatility, we can achieve returns that are much more like high yield like returns. But that's through a very thorough process, relative value assessment, understanding the tail risk, and being diversified and flexible in allocation.
Thanks. And that brings me to another question on your investment team. I mean, we have visited your offices in Chicago, and in London. And I think what was surprising for us as South African investors, how vast the fixed income teams are for in the global space. And I mean, you've spoken about duration and credit, but I know even on the credit side, you're talking about high yield, investment grade, and there are lots of nuances and lots of different building blocks that you use in managing this kind of flexible strategy. So can you maybe just talk about why you need these big teams, just the resources that you have in managing this mandate, the skills you have in the team, but also how you tap into it in what is effectively a best ideas kind of portfolio?
Yeah, absolutely correct. And I should have highlighted that before. There are obviously key, having extremely well-resourced platform is absolutely critical in today's market. We have investors. We manage in fixed income, just under 200 billion, but we have dedicated sector specialists in all areas of fixed income. We cover every sector. We have offices in the US, in multiple offices in Europe, and we have them in Asia and around the world. And that is critical to have local presence and local understanding, and being able to take advantage of opportunities where they present themselves. So there is you never know where the opportunity is going to come. In this strategy, for example, in 2012-13, there was a big dislocation in non-agency mortgages, the old subprime bonds. We have a very, very well-resourced team looking at mortgages. We were able to research all those securities, understand the risk and tail risk of those securities, make an allocation to well-seasoned bonds that were issued in 2005, had great upside, and we invested in that. We held those bonds for 4 years until they got upgraded to investment grade and paid back par, something we bought at very high discounts. 2016, you have late 15, 16, you have the collapse in commodity prices. China's slowdown leads to unwind of the commodity super cycle, creates energy crisis as well, creates a great opportunity to invest in both investment grade and high yield. We have extremely well-resourced team in credit and high yield. We were quick to identify opportunities there to take advantage, and that led to very strong performance in 16 and 17 and 18. So having that team, based in all areas, and then you had COVID last year. I think that's was an extreme market event. We have an extremely well, experienced team. On average, all our lead PMs have, on average, over 25 years of industry experience. Very critical. We have a team that will work together for a long time. So when COVID happened, obviously surprised most people, happened very quickly, but it created massive dislocations because of uncertainty, liquidity. But having experience in that type of environment is absolutely critical. We were quick to mobilize our team, to all the different resources we have around the globe to identify opportunities, and we started by scrubbing our portfolios with taking out positions we're not comfortable with, and then looking at opportunities to add, and looking at balance sheets that we're comfortable with, business plan we were comfortable with, could survive extended period of lockdown, and make those investments. And this is going across the platform, looking for best ideas, and that is absolutely critical. So having the experience, you've done it many times before, you've gone through a crisis, you know what to do, how to identify opportunities, and that is absolutely critical. And so we have over 170 investment professionals that we can tap in this fund, and that is what you need. And then it is obviously on a standing basis. It's just that commitment to research that is critical. We have fundamental research that allows for differentiated understanding of potential value, and more importantly, risk of loss. So a deeply resourced global platform that is integrated to allow those best ideas from around the global fixed income markets to be populated in the portfolio, and being process-led investing. We always follow our process. Our process combines macro inputs and fundamental research in a sensible, repeatable relative value framework that enables us to meet and exceed those objectives that we've set forth in global fixed income portfolios. So those are the key, commitment to research, having the resources and experience, and combining it all in a process and having process-led investing.
Thank you, Jan. I think from our perspective, I mean, what you have summarized very well is that even in a global environment where there are challenges from very, the yields on sovereign bonds being very low, that there is still plenty of opportunity to add value and to generate absolute real returns. But it's clearly not an easy task. I mean, you've got a very well-resourced team, and above that, you've got very seasoned and experienced fund managers. And as you say, the important part of that is being able to know how to react in a crisis and how to take advantage of a crisis to generate the returns going forward from there. So thank you very much for your time today. While it's a very, very complex asset class, I think you have shed some light in terms of why we should have this as a part of our global balanced portfolios. So thank you very much.
No, thank you. My pleasure.
With me, I have James Wilkinson, who is the Managing Director and the Co-Global Chief Investment Officer of the BlackRock Global Real Estate Securities Group. James has 20 years of experience in managing real estate assets, having previously worked at Thames River Capital and Henderson Global Investors. James, thank you for joining us.
It's a pleasure. Thank you for having me.
Before we start, it's probably good to perhaps point out to our viewers that although BlackRock is certainly better known for its passive investment solutions, the global property mandate you manage for us is certainly an active one. To start off with, in South Africa, the listed property universe consists mainly of retail, office, as well as industrial property. How does this opportunity set compare to the global property universe you can tap into?
Yeah, look, this is a great important developments in our global markets, which is the growing diversity in the underlying universe and the assets that listed real estate give us access to. So as you say, the South African market is still dominated by the traditional retail, office and industrial sectors. But across our global markets, this is no longer the case. There's been enormous growth in what a decade ago we might have still referred to as alternative real estate, but really is quite mainstream today. So residential companies, rented residential companies, now account for approximately 14% of our total market. And data centers make up a similar amount. Healthcare real estate, so that's elderly care facilities, hospitals, primary care facilities such as doctor surgeries, also make up a large part of the universe. But then on the other hand, retail companies have shrunk from almost 30% of the universe 15 years ago to about half of that today. And these newer sectors provide us with exposure to different parts of the economy, different business models, different growth rates, and different types of risk. And that's exactly what we as active investors want in order to be able to put together portfolios to meet our clients' objectives. Basically, we want as broad and deep market as we can in order to tap into the best opportunities. And that's exactly what our global markets provide us with today.
Thank you, James. That's really interesting. Some would argue that listed property is already incorporated as a separate sector within the broader global equity universe and therefore does not really need a separate allocation. Now, do you think global listed property still has a place as a standalone asset class within a typical global balanced portfolio?
I do. Real estate offers that is often described, as somewhere between bonds and traditional equities. So, the return typically provides a relatively high and stable income return with a more cyclical capital return on top. And for those reasons, physical real estate remains popular with investors and provides diversification additionally in a balanced portfolio. So allocations to the asset class have been increasing quite significantly over the last decade. But it does have some drawbacks, and particularly for retail investors, it does tend to be lumpy, coming in large lot sizes that are time consuming and expensive to trade. And achieving diversification and operational efficiency requires both scale and significant resources, especially if you want to invest globally and across different sectors, which we believe generates the best long-term returns. But in contrast, listed property companies can offer a liquid proxy for physical real estate with similar return profiles over the long term. And our universe of listed property companies, which comprises around $2 trillion of market capitalization and over $3 trillion of underlying assets across around 400 companies and an enormously diverse range of markets, is a great way to access that underlying exposure. We believe that our universe includes not only some of the best assets on the planet, but also some of the most dynamic real estate on the planet, and that's vitally important for an asset class, a physical asset class like real estate.
So asset managers tend to have very different approaches when it comes to deciding how much regional exposure they prefer to have in their global property portfolios. Some tend to prefer a more benchmark neutral approach from a regional perspective, while others are perhaps more comfortable moving away from benchmark weights. How do you approach regional property allocation, and why do you think this works for you?
Yes, well, that's a great question. I think we always start with the question of what our investors are seeking to achieve. So what's their objective? What's the shape of return that they're actually trying to receive? And so we work with clients to make sure that we have a very clear understanding of their risk budget and their return requirements. And it's really important to stress that risk point as well as the return point, because clearly no investor wants returns that bounce around all over the place from year to year. So we have a clear idea of risk budget, and we can use that in various different ways. And you've alluded to the fact that some investors choose to allocate towards specific regions and then to fill buckets, and others actually use their risk at perhaps a more bottom-up stock level. Actually tells us that bottom-up stock by stock fundamental approach to valuation and portfolio construction is more successful in the long term. So what that means is that we start by valuing each and every one of our companies based on very detailed company analysis, and then we compare those valuations against share prices to very simply identify companies that are either cheap or expensive. So those are the main signals that form the basis for our portfolio construction. And what we've found is that actually sticking to those bottom-up stock by stock signals and building up a portfolio from the bottom up is a far more successful way of controlling risk, and that actually risk tends to compound if we stray too far away from the underlying universe in terms of regional exposure. So that doesn't mean that we're absolutely beholden to these regional weights, but we do have a very clear view that we would rather take our risk within the regions, within the countries, and within the sectors between them. So if you were to look at our typical portfolios, you would see that we tend to be within a few percentage points from the universe exposure, which might lead you to think that we're not really taking very much in the way of risk. But if you were to really drill down, you'd see that we do have very clear conviction, which we express in our individual companies, because that, coming back to the original dialogue with our clients, that we believe provides us with the best risk-adjusted returns and the best way of providing that satisfactory return for the investors. So put simply, we've chosen to use our risk budget at that company by company level rather than to try and play one region off against the other.
Very interesting. Property investing is certainly not without risks. We've seen trends that have challenged certain sectors, such as, for instance, the adverse impact of e-commerce on retail over the last decade, and perhaps more recently, the pandemic having created a lot of uncertainty for sectors like office, hotels, as well as retail. How do you approach the need to balance risk and the opportunity for returns, given these challenges in the property sector?
Yeah. Well, let me first sort of take a step back and look at this from a high level. Real estate serves to enable economies and societies to function. So it provides the physical environments for the full range of activities that keep the world ticking over. And therefore, as societies and economies change, so does the real estate sector. Now, we've been writing and talking about what we would refer to as mega trends that are shaping our world and influencing the sectors within it for years. Demographics, social change, technological developments, and climate change are all changing the way we use physical real estate. Retail spending is obviously shifting from in-store to online, leading to less need for physical shops and a greater need for logistics space to distribute direct to the consumer. And similarly, the huge growth in IT systems, and mobile data usage has created enormous demand for data storage, telecom towers, which has obviously driven the growth of the data center and towers businesses. You refer to the pandemic, and yes, absolutely, that has had a huge impact on mobility, and that has meant that real estate has been in the spotlight. Pre-existing trends, such as that move to online that I just referred to, have been accelerated and amplified, but also cash flow risks that nobody would have thought about a few years ago have taken centre stage. So who would have forecast that Australia, the US, most of Europe would effectively close their borders to travellers, or that hotels, cinemas, shops and even offices would be forced to close for prolonged periods of time. Now, our job is to work out which of these changes are temporary and which are permanent. And if temporary, how long will it take to get back to normal? And how much will future cash flows be impacted by changes to previous practices? These massive changes do create risks, but I think it's really important to remember that they also create opportunities. Markets are incredibly attractive, and wherever there is a need for capital and an appropriate return to be generated, there will be an entrepreneur prepared to step up and connect the two. So on balance, we are not alarmed by what has been happening over the last year. The disruption and the terrible human cost that the virus has caused has clearly been very difficult to live through for all of us, both at a social level and at an economic level. But from that economic and markets perspective, we feel very confident in the opportunities that lie ahead. I think it's important to remember that real estate is at heart a pro-cyclical asset class. While it does appeal to the spread investor as a great way to generate income, it actually does best when economies are growing, businesses are expanding. So as we come out of the downturn caused by the coronavirus, and we will, the amount of fiscal and monetary support has been absolutely unprecedented, to repeat a word that has been rather overused over the last year. There will be opportunities for the best real estate management teams to generate attractive returns for investors. And with our rigorous, robust and consistent approach to the identification of value, we believe we're very well placed to continue generating the right returns for our investors.
James, that was really insightful, and I think that our viewers have a much better appreciation now for global property as an asset class, and especially your approach in managing it. So thank you for your time.
Thank you.
In conclusion, I would like to thank you all for joining us today, and I hope you found these sessions insightful. Please do get in touch with your wealth account managers or fund and investment specialists if you have any additional questions on the Old Mutual Multi-Managers Global Range. Thank you and goodbye.